Я работаю в криптовалюте.
Hi, I'm Satoshi Nakamoto. Welcome to my news channel about cryptocurrency, where the most relevant news and promising projects will be covered.
Explanation of the falling wedge pattern. The market rarely moves in a straight line. Even during established trends, prices move in a zigzag fashion, creating oscillating highs and lows. This behavior is characteristic of most assets. Consequently, within bullish trends, investors often encounter brief negative corrections that give rise to patterns such as wedges, triangles, flags, or channels. This indicates that profit-taking is temporarily reducing buying pressure. The chart pattern known as the falling wedge is formed by drawing two descending trend lines, one connecting the highs and one connecting the lows. The highs decline at a faster rate than the lows. This is visually represented by the trend line connecting the highs having a steeper slope than the trend line connecting the lows. A valid falling wedge pattern requires a minimum of 5 reversal points, 2 to define one trend line and 3 to define the other. This pattern derives its name from its final shape, which gradually narrows into a wedge over time. It is crucial to interpret the falling wedge as an excellent buy signal, indicating that a trend reversal is imminent. Examples of falling wedge patterns. 2 examples of the falling wedge pattern are provided below. A falling wedge occurring within an uptrend indicates that the prevailing bullish trend remains intact. This scenario develops when prices record lower highs and lower lows relative to previous price movements. This allows traders to average down on their existing market positions or to initiate new long buy positions. A falling wedge occurring within a downtrend signals a potential reversal toward an uptrend. It forms when prices register lower highs and lower lows relative to prior price movements. This presents buyers with trading opportunities to enter the market. Is the falling wedge pattern bullish? Even if a falling wedge pattern appears within a bearish trend, it remains a bullish formation. This signifies that bears have momentarily gained control over the price, while bulls have lost momentum. Consequently, the price begins to decline toward new lows, albeit at a corrective pace. How to trade the falling wedge pattern. Utilizing the falling wedge pattern in trading involves 6 primary steps. The first step is identifying the wedge pattern on the chart. Second, watch for a breakout. The third step involves validating the breakout. Entering the trade constitutes the fourth step. The final stage involves setting a stop loss and, ultimately, establishing a profit-taking plan. Locate and identify the falling wedge pattern on the chart. Draw trend lines connecting the swing highs and swing lows to clearly define the pattern. Watch for a potential breakout. This indicates that the price is moving beyond the boundaries of the established wedge pattern. Validate the breakout. Verify that the price has indeed broken out of the wedge. Ensure that you have drawn the trend lines correctly. Typically, these are drawn by connecting the consecutive swing highs and lows. Enter the market. Open a long buy position once the price crosses above the upper trend line of the falling wedge pattern. It is crucial to set a stop loss. Some traders choose to place their stop loss order just outside the breakout point of the pattern. Others set their stop loss closer to the entry point to minimize the potential loss size. Risk management is a critical aspect of trading. Set a profit target and determine how you will close the trade once it becomes profitable. The widest vertical distance of the wedge, measured at its base, projected upward from the breakout or entry point, represents the expected profit target. Pros and cons of the falling wedge pattern. Pros. The ability to enter a trade even after missing the initial move, a defined target price, a favorable risk-to-reward ratio, high frequency of occurrence, clear levels for stop losses, entry points, and profit targets, as well as enhanced accuracy. These are the primary advantages of the falling wedge pattern in technical analysis. The falling wedge pattern appears regularly across financial markets, including stocks, commodities, forex, and cryptocurrencies. The pattern features distinct levels for profit targets, entry points, and stop losses. This trading technique allows traders to place stop losses at predetermined levels to limit potential losses. Traders' stop-loss orders are often placed just below the support line of the falling wedge pattern. It offers a positive risk-to-reward ratio. When a trade has a positive risk-to-reward ratio, the potential profit outweighs the potential risk. Using the falling wedge pattern, traders can enter a trending market after having missed the initial profit opportunity, serving as a continuation pattern. Traders utilize the falling wedge pattern to establish a target price for long positions. Typically, the vertical distance measured from the breakout point to the widest part of the wedge determines the price target. One of the key components traders need to execute successful trades is an appropriate risk-to-reward ratio, a feature for which the falling wedge pattern is renowned. Providing traders with specific levels for stop losses, entry points, and profit targets also aids in risk management and maximizes profit-making opportunities. Cons. Technical analysts identify 5 primary drawbacks associated with the falling wedge pattern. It can be confusing, requires further confirmation, generates misleading signals, is frequently misinterpreted, and may result in the placement of an inappropriate stop loss. It can be confusing for novice traders. Traders must determine whether converging trend lines truly represent a falling wedge pattern or if they are merely part of a longer period of consolidation. Confirmation of the falling wedge pattern using oscillators and additional technical indicators is essential. It frequently generates false signals. When a pattern suggests a specific outcome, such as a bullish reversal, but the market moves contrary to expectations, this is referred to as a false signal. A falling wedge can signal either a continuation or a reversal pattern. Correct identification is key. Conclusion. The falling wedge pattern, which can indicate either a continuation or a reversal, often produces false signals. Therefore, correctly recognizing the pattern is of paramount importance. The falling wedge serves as a useful tool for experienced traders, though beginners should exercise caution when utilizing it. Go for it!
Like and subscribe to the Crypto Plus channel. Modern technologies have radically changed our society, where cryptocurrency has long been the means of payment. The concentration of capital and the growth of cryptocurrency turnover around the world is already today, where scattered small banks are being replaced by cryptocurrency cross-border payments. One of the most important modern decentralized tokens is Soviet gold chervonets, SOVAUCHER, built into the system of cryptocurrency exchanges and allowing financial transactions, which is the most suitable in the system of gaining your freedom and independence. You are on the right path, comrades.